I bet you've walked around the supermarket and thought, hang on a minute, that's gone up again. Tea, coffee, beans, bread, doesn't matter. You've noticed it all going up. It means you've encountered one of the most important economic forces affecting all of us. Now, the chances are you have a degree or you're working towards one. You can probably analyse literature, solve complex scientific problems, but do you really know what real wages means? Do you know what purchasing power means? If no, you're not alone. See, our education system does a fantastic job of teaching us to think critically about almost everything except money. Research conducted by Census-Wide on behalf of Lenvy states that only 23% of Gen Z borrowers report receiving any sort of financial education from college or secondary school. Now, if that's true, 3 in 4 young adults are coming out with no financial education at all. In this video, I'm going to break down everything you need to know about inflation. What it is, why it happens, its hidden effects, and most importantly, what you can do to protect yourself from it. By the end of this video, you'll know more than your friends and you'll be able to take immediate action to better your finances. Hi, I'm Matt. I have over a decade of experience in the asset management industry. I've worked for 2 world-class hedge funds and I have the CFA designation. Inflation is the rate at which the general price levels of goods and services increase over time. So what your money can buy you today buys you less than it did yesterday, and what your money can buy you tomorrow will buy you less than it does today. I don't need to tell you that 20 in your pocket doesn't buy you around in the pub anymore. You've experienced inflation even if you didn't know what it was. Think about it for a second. You go around a supermarket, you put your usual items into the basket, you get to the checkout and you notice that total price just keeps going up and up and up. This is inflation hitting your food budget. Housing is probably where people feel it most acutely, especially if you're renting or renovating. You saw the prices of materials after COVID, right? It isn't just big expenses either. Gym membership, streaming services, your phone plan, all these costs tend to go up over time, especially your phone plan. It's now written into contracts where it deliberately goes up every year in line with the RPI. It's not always about company greed, although an opportunity to raise prices for the bottom line definitely won't go amiss. Salaries, tech infrastructure, advertising, these costs tend to inflate over time. There's also another subtle way that you're paying higher prices: shrinkflation. I promise I didn't just make that up. It's when prices remain the same, but you get less product. It's particularly devious because it's designed to be invisible. You'll see adverts about price freezes, and maybe even some companies bragging that they've lowered their prices to help you out. But in reality, they're sneakily shrinking their products. It's just another way inflation is affecting your purchasing power. The crucial insight here is that inflation isn't just about prices going up, it's about the purchasing power of your money going down. That emergency fund that you should be building, if that cash is just sitting in a checking account or a current account, earning little to no interest, then you're actually losing money in real terms. You're getting poorer. Sure, your account balance might be growing, but that money will buy fewer goods over time. Before I tell you what causes it, let me share this stat with you. In total, 76% of 18 to 27-year-olds are expecting to borrow for the cost of living in 2025. I found that stat shocking. 3 in 4 young adults are borrowing just to live. If you're struggling to pay for necessities, you're not alone. It's not your fault. It's really tough out there. How have you felt the effects of inflation? Let me know in the comments below. Now, you might have wondered, why does this happen? What causes inflation? Well, the first major factor is demand pull. This is when there's too much money chasing too few goods. When people are willing to spend, but there aren't enough goods and services to meet that demand, prices rise. Stores run out of goods, and services firms run at full capacity. This is what happened in the pandemic era. Many people had stimulus checks and there was a lot of pent-up demand, but many sectors couldn't ramp up production fast enough to meet that demand. This is an example of the supply chain disruptions after COVID. Then there's cost push inflation. This is when the cost of production increases and businesses pass some or all of those costs onto customers. Expanding capacity to meet demand, hiring sprees, increases in energy and shipping costs all show up in the prices you pay. Energy costs are particularly important because energy is an input for almost everything that's made. When there's a price spike in oil, it doesn't just affect you at the pump. It affects the costs of manufacturing and transportation of goods, even heating buildings where people work. Businesses don't absorb these costs, if any at all. They pass them on to you and me. Another factor, less spoken about, is currency devaluation. This is when a country's central bank, such as the Bank of England or the Federal Reserve in the US, increase the money supply. They print more money. It means that each pound or dollar is now worth less. Lowering the value of a currency can increase import costs, as it takes more of the domestic currency, your currency, to buy foreign currency. So you can see there are several factors in play, and understanding them can help explain why inflation isn't always predictable or easy to control. The most common measure you'll hear about is the CPI, the Consumer Price Index. It's basically just a massive basket of goods and services that typical households buy. So petrol, food, entertainment, whatever. Every month, statisticians compare the prices of these goods and services to the month before and the year before. The CPI tries to reflect what people actually spend their money on. So it's updated periodically. New goods might enter the basket and old ones will drop out as people don't buy them anymore. These measurements aren't perfect, but they're a reasonable way to track the cost of living over time. Now, it's important to understand that the headline inflation rate that you hear in the news might not be your own personal rate of inflation. You might buy different products to what's in that CPI basket, or buy them in a different composition, so you might buy more of one good than another. Unless you buy the same things week in, week out, scan all receipts, and track the prices yourself, it's hard to know exactly how your personal costs are increasing. If you want an estimate of your own personal rate of inflation, then I've left a link to a website below, so check it out. Inflation doesn't affect everyone equally. There are losers and winners. For the losers, that'll be fixed salary workers like most of us, and pensioners, where they have a fixed amount of income coming in each month, but each month their costs are increasing. So their standard of living is slowly eroding over time. Then there are savers, with cash sitting in a low interest account, losing purchasing power every day. Now, I've actually made another video which relates the time value of money, the most important concept in finance, to your savings. Check it out. Another group that loses to inflation are borrowers with variable rate debt, whose creditors increase rates as inflation runs higher. Believe it or not, there are winners though. If you have fixed rate debt, such as a mortgage, then increasing inflation is actually a good thing. This is because as each day passes, you're paying back the loan with money that's worth less than when you borrowed it. So that outstanding balance that you have is actually decreasing in real terms over time. Another group of people that benefit from rising inflation are those that own real assets, because they're limited resources, unlike money, which can be printed by central banks when they see fit, e.g. during the GFC and the pandemic. So what can you do about this? How can you protect your money? First of all, even though inflation eats away at fixed rate debt, the chances are you're being charged far more than the inflation rate. So pay down any high interest debt that you have, store cards, credit cards, buy now, pay later, which will definitely creep up on you. Hopefully this will free up some cash for you to start an emergency fund if you don't already have one. Then think about where you keep your money. Cash might feel safe, but it's guaranteed to lose purchasing power over time. Down the line, it will buy fewer goods than it can now. Now, don't get me wrong, build up the emergency fund first. It'll be really helpful in a situation just in case you lose your job or there are unforeseen bills that fall on your map. But saving in excess of that emergency fund amount will actually hurt you. Consider investing any excess cash beyond your comfortable amount. What is your comfortable amount? Well, it's going to be different for everyone, but for me personally, it's 6 to 12 months of outgoings. If you could cut a ton of monthly expenses and live frugally, what would that amount be? How much would that be each month if you could live on the bare minimum? Then I would times that by 6. And if you're still not comfortable with that, then you can always increase it. Personally, I think 12 is quite a good backup, but it will depend on your personal circumstance. Investments that tend to do well in inflationary periods are stocks, though not all stocks are created equal. This is because some companies have the ability to increase their prices as their input costs increase, and others don't. But it does ensure that there's a buoyant stock price if they have the ability to increase those prices. Other investments include commodities, such as energy and metals, also real estate, but it requires a lot of upfront capital and is prone to political risk, such as in the UK, where the UK government has killed the residential property market. Now, it's important to understand that the performance of these assets behave differently to each other and over time and in different inflationary periods. However, there are investments that are specifically designed to protect you from inflation. These are inflation-linked bonds in the UK or Treasury inflation-protected securities in the US, TIPS for short. Now, these are government bonds that adjust their payouts based on the inflation rate. Putting financial markets to one side, the best thing that you can do is invest in yourself. By developing your skills, you become more valuable in the job market. The best protection that you have against inflation is increasing your income. People with in-demand skills and the ability to negotiate higher wages are much better positioned to maintain a standard of living when prices rise. If you're planning a major purchase, really consider if you need it. Fair enough if your fridge freezer goes, right, everyone needs one. But do you really need the latest iPhone or the new car? Don't give in to those insecurities that you may have. Right? Forget other people, forget what they think. It's their problem. Unless, of course, the value that you extract from these things brings you genuine happiness, then go for it. But keeping up appearances keeps you poor. Understanding inflation is crucial as it affects every financial decision you make, from where you put your money to when you make those purchases. How much inflation affects you depends on how high it is, how long it lasts, and how your finances are set up. People that understand it are the ones who maintain their standard of living and build their wealth over time. The key takeaway to all of this: pay down that high interest debt, shift savings into a high interest account, and any cash beyond your emergency fund, invest it. If you know someone that's interested in personal finance and investing, then please share this video with them. Let them learn too. I'll see you in the next video.